Today we're diving into Deckers Outdoor Corporation, traded on the NYSE under the ticker DEC. Deckers, also known as Deckers Brands, designs, markets, and distributes footwear, apparel, and accessories. They own some iconic names. UGG, famous for its sheepskin boots. Hoka, known for high-performance running shoes with maximal cushioning. And other brands like Teva, Koolaburra, and Ahnu. They sell through wholesale partners, international distributors, and direct-to-consumer channels via their own stores and e-commerce platforms. Manufacturing is heavily concentrated in Southeast Asia, about 95% in Vietnam and less than 5% in China. A key point given recent tariff developments. Deckers stock has taken a beating, dropping over 50% from $217 in January 2025 to $101 in August. What caused the fall? First, tariffs and rising costs. Early in 2025, new U.S. tariffs hit countries where Deckers manufactures, raising costs significantly. Material, freight, and shipping expenses also climbed. Second, slowing momentum, especially in Hoka, and conservative earnings guidance. Third, soft forecasts and a prior overvaluation. At its peak, Deckers traded at 7 times sales, which made the market nervous. And finally, sector-wide weakness, with peers like Lululemon and Nike also feeling the squeeze from consumer uncertainty and geopolitical risks. UGG and Hoka now contribute roughly half each to revenue. Sales grew about 16% in 2025, consistent with the 15 to 19% range over the past few years. Hoka remains the faster grower. International sales are accelerating faster than U.S. sales, with the U.S. share of total sales dipping from 67% to 64%. Interestingly, wholesale grew faster than direct-to-consumer this year. Over time, revenue, gross margins, operating margins, net income, and free cash flow have all improved. In 2025, gross margins rose thanks to a favorable product mix, more high-margin products, especially from UGG, and reduced closeouts to the wholesale channel. Return on invested capital has jumped from 21% in 2021 to 29% today, an excellent sign of efficiency. We use a reverse discounted cash flow model to estimate what the market's implied growth rate is at today's price of $101. We obtained an implied growth rate of about 7% over the next 5 years and 4% for the 5 years after that. The implied growth rate is significantly lower than past 5-year net income or free cash flow compounded annual growth rate of about 28% and indicates market is pricing in a material slowdown in growth. Deckers expects tariffs will increase costs by $150 million to $185 million in fiscal 2026. But Deckers expects to offset about half of this through selective price increases and cost sharing with manufacturers. The market's implied growth rate is just 7% over the next 5 years, far below Deckers' historical 28% net income growth. Assumes Deckers absorbs the full tariff impact and hence suggests that expectations might be too pessimistic. We ran a simple discounted cash flow model using conservative growth assumptions, 15% annually for the next 5 years, and 8% for the 5 years after that. That gives us an estimated fair value of $152 per share. With the stock at $101, that's about a 50% upside and a solid margin of safety. Here's the bottom line. Deckers is still growing revenue in the mid-teens. ROIC is high at around 29%, showing strong capital efficiency. Tariff impacts are manageable and less severe than feared. At $101, the stock appears undervalued, offering both a margin of safety and a potential buying opportunity. Let me know in the comments what you think. If you found this analysis useful, give the video a thumbs up. It really helps the channel grow. And if you want more deep dives into stocks like this, make sure to subscribe and hit that notification bell so you don't miss the next one. Thanks for watching, and I'll see you in the next analysis. Bye.